Well, we're back. Episode 22 of the Capital Spotlight podcast with your host and the Director of Business Development at Lone Star Capital, Craig McGrother here, alongside and virtually with my dear friend, Mr. Two-time author, the founder and principal of Lone Star Capital, Rob Beardsley. How are you today?
I'm doing excellent. I'm full of energy, excited to talk about all the amazing things we're going to talk about today. So I feel like we're going to talk on 2x speed today because we have so much to cover.
We have a lot going on. I feel as if the energy is infectious within the Lone Star Capital team, and a lot is brewing right now. I feel like momentum has never been stronger. I'm excited. Are you excited?
Very, very excited.
Good. Well, there's a lot to cover today. This is a jam-packed episode. You will not be disappointed. Let's go through what it looks like real quick. Some housekeeping items. We're talking about the fund to fund document. Rob just met with his new mentor and best friend at lunch today at a very private JP Morgan event. The fund to fund document and discussion. We're going to continue that. Conferences plus thought leadership, lack of buyers in the market, the loan assumptions, and then some real deal watch lists. A lot to pack. First off, housekeeping items. So we have our fund to fund webinar on November 30th at 2 p.m. Eastern. So you do not want to miss that. If you're curious to know about the fund to fund program, what that means, we're going to debunk some myths. We're going to really talk about how this will be implemented into our deals. And this will really help us scale and help maybe some new fund managers, or if you're in the industry wanting to work with fund managers as opposed to co-GP, you don't want to miss that. Let us know if you need any help with that. We'll probably link it somewhere if I'm not mistaken. So want to mention that. If you're a fund manager or if you're an LP, if you're an investor, if you got a 1031 exchange, reach out to me, please. My email is craig@lscre.com. Once again, it's craig@lscre.com. We're looking to raise more equity. We're about to buy every single deal in Texas next year, so we need your equity. We can't do it alone, so we'd love to work with you and provide some value, provide some investment alpha, and give you above market rate returns, of course. So if you're a capital partner, anything like that, let me know. Also, new show coming out, Fun Friday. I think the first episode will
Tomorrow.
have just aired with Travis, yes, tomorrow. So that's really fun. And then Sam Silverman the next week. If you're a fund manager wanting to be on the show, an interview style, let me know. Reach out to me. I'm potentially open to having you on our series, on our channel. This is very exciting. And then something that I want to touch base on, this is a housekeeping item, of course, is we raise more than institutional equity. So recently, as some of you guys may know, I do a lot of the conversations and outreach in reference to our capital stack and finding new equity partners, as Rob is finding ways to double and triple the company's revenue. So I'm doing a lot of that stuff. Of course, Rob is there, but we raise more than just institutional equity. So we raise from people who want to pool their friends' money together to create, 500K to maybe get better economics. We work with people who raise $1 million and they're just full-time capital raisers, but they're not, under a firm like BlackRock. And then, we have LPs in there that are giving us sometimes $100,000 checks.
We have a
So
$50,000 minimum. That's accessible. I mean, we one of our mantras is we like to do smart things with smart people, which lends itself to working with more savvy institutional partners. But with that being said, we take the savviness and the sophisticated nature of our operations and investor relations, and we serve that same exact style to our individual investors that might only be putting in a 50K check. So we take that very seriously, and I think what you're trying to get across to everybody is that, look at Kent snooping on us,
I know that's
is
the first time this podcast sidetracked has ever seen a glimpse of the other key principal.
so
Ken.
in case you're wondering, no, Kent is not a figment of my imagination. He's not my make-believe business partner. He does truly exist. He's just too busy being very, very smart to ever show his face on camera. But
And he's not
anyway,
your dad, is he?
no,
Because there's some people wondering, is the other key principal, according to TikTok, is that your dad? It's not your dad because your dad was just on the podcast.
there you go. Episode 20, perhaps. So
Perhaps.
so we do have a diverse base of investors. We welcome all investors. We're not trying to just work with institutional investors, but like you're saying, we do get that myth said about us. It's like, oh, those Lone Star
Often.
guys, they only do institutional equity, they only do JV, and we're just out here saying that's not true. I mean, people know that, but if you're interested in working with us, know that we would love to work with you as well. We don't We don't have high minimums, nor are only looking to invest with big partners. So please get in touch with us. We'd love to work with you. And if you do want to actually partner with us more than just an LP, and you want to participate as a fund manager via the fund to fund program, you can do so by learning more on the fund to fund webinar we're hosting on November 30th. Like Craig said, just email Craig and he'll send you the registration details to join us live on that call.
Yeah, really big about that. So, and just to really unpack this and really break this out just an ounce further, if we were to raise, let's say, $10 million for a deal, what would that capital stack look like in reference to institutional equity, our friends and family, our retail investors, and then, other non-institutional, big corporations providing checks, the everyday capital raiser?
Sure. So we've raised in total over a little over 200 million in equity, and about almost 50 million of that has been institutional type JV, family office, private equity. So that's only 25%. So a good 75% of our capital comes from retail, high net worth individuals, and smaller time fund managers. So it shows you kind of the breakdown. But the way that we would do a $10 million equity raise typically would break down in two ways. One would be the syndication style, where there would be no major investor, and there would just be maybe 50K investors. There would be maybe $1 million investor, but everyone would be a minority investor, and that would be in the syndication format. We would bring on fund to fund partners that would pool together their investors to raise $1, $2, $3, $4 million. And that would be the syndication style. Then we have the joint venture structure, where we would actually go to one of our more institutional type partners, and they would contribute, let's say, 80 or 90% of the equity. So they would put up $9 million of equity, and Lone Star would put up the other 1 million, which would be coming from our personal Lone Star capital, as well as friends and family of Lone Star. And so that would be a 90-10 JV. And in that structure, the institutional investor putting up 90% of the equity would have major decision rights, and they would be a true partner in every sense of the word. So those are the two styles. We welcome both. We like doing both. There's advantages. We'll cover that another time, I think, on the show.
Yeah. And, sometimes there's deals like maybe one we aren't looking at right now that is maybe a little bit small for an institutional player, because it's about maybe a $10 million check size. And we could probably slice it out with 5 partners and Lone Star that are not maybe the institutional size. So there's, if you're looking at a puzzle, there's multiple different sizes and pieces for it. So we want it to all fit together. We want all pieces of the puzzle, which means if you're, that 500K to $2 million mark, there's plenty of space for you in our capital stack usually. And that sometimes is the nicest little gap to solve for, is that size. So please reach out to me once more if you're looking to raise equity for any deals and looking to partner up a multifamily, take advantage of the once in every decade or so opportunity of investing and getting into the market like we're going to see in 2024 and 2025. So moving on, you had a really fun lunch today with some JP Morgan private clients and someone who is very influential to you. And maybe you can debunk this rumor. Is he or is he not your new mentor now? Is he or is he not investing with Lone Star? Barry Sternlicht was in attendance. You guys shared the same room. We're breathing some of the same air today, correct?
That is correct. Kent and I went up to Midtown for a luncheon with Barry Sternlicht, Starwood Capital, of course. We haven't done business with Starwood, but we are in touch with them. So that would be truly an incredible moment and a dream come true to partner with somebody like that, who when I first got into the business, would watch his talks and study what he was up to and the likes of Sam Zell and whatnot. And it was really cool to see him in person for the first time and see how he speaks, carries himself. And he was essentially there raising capital, right? So basically JP Morgan. So he's out raising a $10 billion distressed fund. That's what he's doing right now. And he said 2024 is going to be the best year to invest in the last 20 years, he said. Something like that, right? I mean, that doesn't make sense to me, because I feel like 2010, 11-ish, 12 maybe would be better. But he's very bullish on property performance, right? Apartment rents are doing well. Occupancies are doing well. He's obviously not bullish on office in the US, but he was bullish on office in Japan and in Germany. So he was bullish on quite a few things around the world, which was interesting to hear his world view, right? Because we're just so focused on Texas multifamily. But basically, he thinks that performance can be strong. It's just debt is the issue. And so he's out looking for good deals, bad balance sheet, where he can fix the capital structure and make outsized returns. So he's out there raising that $10 billion fund, and JP Morgan raises a fund of funds. What do you know? They raise a fund of fund for Starwood. And so Starwood was one of the earliest sponsors to be on JP Morgan's platform and raise an opportunity fund through JP Morgan and JP. So the Starwood fund has a $5 million minimum. And then JP Morgan goes and creates a fund of fund, and their minimum is 250,000. So if you want to get access to Starwood into this $10 billion fund, but you don't have 5 million bucks, you can go to JP, pay a little extra in fees, and then get in for 250,000 or what have you, right? So this is an interesting example of the fund to fund structure. But no, unfortunately, he is not my mentor, but it was very cool to check him out in person.
So that's the first time you let me know that cool information, because I spoke to you probably 10 minutes after you departed from the room, and you said I'd have to wait to get the scoop with everyone else in real time. So thank you for that. Very interesting that he says 2024 is the best time. And we've kind of talked about this as well on this show, and, with our friends who also care about, general economics and just, being curious as we are. It seems as if the recession coming up, or a lot of the crashes we'll see likely, is due to the short-term nature and the delta of where rates are today and where they were a couple of years ago, and the maturities coming up. So he's likely forecasting that, hey, performance is still pretty good, but you can't outrun bad debt, which we're going to talk about a lot of that on the show as it goes through the watch list that Real Deal commented on. So that'll be interesting. But it is good to hear that that opportunity is so ripe, because I do believe as well that these next coming year are going to be very fruitful. I have said this to you, and I'll say it again and again. I think we're going to get very aggressive, and I want to get as aggressive as possible and really try to push the envelope and go crazy in the next couple of years to make these acquisitions. As JC commented, even on the show, as many people do, you don't know how long the window is going to last, where cap rates are expanding to right now, and how everything's looking. It's very exciting.
So let me just add to that, because I know when usually the word aggressive doesn't come out of a sponsor's mouth, right? What do sponsors say? We're conservative underwriters. We are conservative.
Said every under, yeah,
Everyone's
every sponsor
conservative.
ever, right?
Exactly. So, well, listen, the time to be conservative is over. The time to get aggressive is 2024, because the opportunities are going to be so attractive. So, but let me also just say that as a sponsor, we're constrained by three things. We're constrained by deal flow, we're constrained by capital, and we're constrained by bandwidth, or said another way, human capital. So what that means is we can do as many deals and grow the portfolio as much as those three constraints. So if we're not seeing good deals, then we can't grow. If we're seeing good deals, but we don't have the capital behind us from a debt and equity perspective, then we can't capitalize on those opportunities. And then thirdly, the one that's least talked about is bandwidth, or human capital. If you have the money and you have the opportunities, but you're just too busy to take advantage of all of them, then you're bandwidth constrained. And so historically, when we first started the business, we were absolutely capital constrained, because raising money was so challenging. Who would bet on us? We're a new firm. We're young. It's a competitive market. There was good deals though, right? So we did well.
And that might have been a blessing, frankly. Maybe not right away, but shoot, in 2020, 2021, I'm guessing you're probably happy you didn't get every single deal, frankly, because that could have put us in a precarious situation now and whatnot as well, right?
Well, at that point, we were less capital constrained. At that point, we could raise equity. At that point, we were constrained by deals. We just weren't, we were bidding on everything, but we were just getting outbid. But I'm talking about 2017, 2018, the deals were attractive. It was just raising equity for us was very difficult. So first capital constrained. Then as the market got hotter and hotter, we got more deal flow constrained, right? Because opportunities were so thin and the market was so competitive. Now, I think 2024, we're going to head into a period of being bandwidth constrained. We're going to get so busy, because I think there's going to be so many good opportunities that we're going to have to turn good deals away, because we're going to be so busy working through and doing due diligence and underwriting and raising equity and closing on and managing and integrating into our portfolio all these new properties.
I'm already seeing that right now, and it hasn't even gotten that busy yet, because I'm looking at my calendar right now. I'm looking at my inbox and I clear it out. And then in the morning, I get 40 new emails that are not just quick deletes or one word send offs. These are very thoughtful, very played out and time comprehensive and consuming emails. So I feel busy right now. And I know for fact and for certain it's about to get a lot busier, and I'm all for it and with it. And it's exciting, but that just goes back to, hey, if you're a capital partner, if you're a fund manager, please, we're going to need some support here and some help and to create new partnerships to really do what we want to accomplish here coming up. So it's all very exciting. It's good problems to have. I'm sure from sitting on the chair that you're in, from taking this thing to a scrappy little startup to a no office to a big office in a beautiful building, it must be a dream to feel like where we are right now and how we're positioned, right? Because on the equity conversations I have, it's so nice to tell people we don't have a sea of issues coming up that we have to face in 2024 and 2025 with, bad debt situations. So it's exciting. It really is. It's exciting. So what's your perspective with all that said?
Yeah, it is exciting. I think we're very well positioned. Like you said, we have one bridge loan in the portfolio. So anyone who has a bridge loan in their portfolio knows what we're talking about and knows the hardship that you are dealing with floating rate debt, with looming maturities and battling back on those sorts of issues. But there's a difference between having 1 and 20. So 1, we can manage. We're going to be just fine. We're good. 20, I don't think we'd be able to manage. That's really, really tough.
Well, and equity calls we'd be having wouldn't be, someone like myself in the firm saying, hey, great news, we have a new deal. It's like, hey, we have to take your $50,000 not to deploy to a new deal, but to save this deal. Do you want to do it? And having that situation be tough. Moreover, you start making a lot of capital calls, and those equity providers that you have aren't going to pick up the phone as quickly. There's less buzz and momentum. The one thing I can really feel, and I'm sure you feel it too, it's crazy, is just the amount of buzz and momentum we have right now versus the other side of it, which is just, trying to get to neutral and trying to get back there, as opposed to putting your foot on the gas and crank it into fifth gear, humming into sixth gear as the new year starts.
Yeah, it's interesting. And I mean, we're getting maybe off topic, but as far as capital calls go, you don't want to be first in the market because you're going to get the finger pointed at you, and it's going to be, what's wrong with you? Why are you making a capital call? My other sponsor down the street's not making a capital call. They're just fine. So there's reputational harm associated with being first. But if you get the capital call, it's more important that you actually get the money to save the deal and take the momentary reputational hit than it is to be last. What you also don't want to be is last. You don't want to be first or last, because if you're last making the capital call, those investors might be fatigued by all the other capital calls going on in their portfolio. And they're just going to say, no, I'm not going to put good money after bad. And then that deal is going to get wiped out. So we've talked about this actually before on the show. We talked about how we actually sounded the alarm bells to our investors way before. And I mean, I don't want to say way before anybody.
A year ago.
Way before a lot of other people did. And the finger was being pointed at us. They were saying, well, there must be something wrong with you. You guys must have bought bad deals. What's going on? And we were just looking at the math. We're just saying, hey, guys, this floating rate stuff, this is a problem. We need to act now. We need to be decisive. And thankfully, we were decisive. And we're in a very, very strong position today to take advantage of 2024, which unfortunately, on the other side of those opportunities are people that are experiencing distress and are going to be forced sellers into a market where they're going to take big losses. So I think we can move on from this topic, but yeah, that's a very exciting position for us to be in.
Yeah. Moving on to something that we're really excited about. As we said, we're going to have the webinar on November 30th, but can you pull up our sleek, shiny, beautiful, just created fund to fund document, please?
Yes. Give me 1 second.
Take your time.
Honestly, I forgot that we were going to share our screen on this one.
Yeah. Well, be prepared for the unexpected, as they say. Expect the unexpected. But with that said, fund to fund document. So if you're listening to the show, this is bad radio. But if you are watching, you'll see our nice brochure. So with that said, though, one thing people have asked, are we creating now a fund? And this is just some feedback live in real time that I saved for you, just like you saved the information for me. Are we setting up now a fund structure where it's basically blind to our discretion? Why are we doing this fund to fund route? How does it work?
Yeah, it's good that you sent this out to our partners and we got that feedback so that we can address some of these things and then sharpen our pencil and address more of these concerns on the webinar coming up. But as we talked before on the show, fund of funds is a new-ish structure for fund managers to be able to raise capital from their investors and then partner with sponsors like us. So it does not mean that we are forming a fund to invest on a discretionary basis. These fund of funds are still single purpose vehicles investing directly into a specified asset. So the way it works is we would put a property under contract and that property has an SPV. And then a fund to fund partner would come to us and say, hey, I'm interested in raising $1 million for this deal. We would create an SPV for them whose sole purpose would be to invest into our SPV, right? That's the fund of funds name.
And yeah, and when you say fund manager, just want to clarify, some people that are not as common to this, the industry is changing. A capital raiser is a fund manager in this sense, a fund to fund partner. So if you are a capital raiser, if you raise money for deals, you place money in deals, you could technically become a fund to fund partner, a fund manager that all floats and functions through this. So I just want to clarify that. Some people were a little bit confused. I'm sure some of you people are like, yes, obviously, but everyone learns a little differently, and phrasing can always be slightly varying. So just for the record.
Yeah, exactly. Capital raiser, co-GP partner, fund manager, interchangeable. So that's the kind of the structure that we put together here. And so you can just see why partner with us through the fund of funds. Lone Star is a best-in-class multifamily sponsor who you can trust with your reputation and your investor capital. I think the really exciting thing about this structure is how seamless we make it for our partners. You come to us and you say, hey, I want to raise from my investor base. I have a strong investor base. I want to raise $1 million from them. We create the legal docs for them, form the entities, open the bank account, handle the subscription and the funding process to that account. And then that $1 million then gets wired to the main deal entity. And then the ongoing notifications and taxes, K1s, everything, we help through that whole process. So everything is seamless. Basically, the idea is hands-on support with fund to fund underwriting, marketing, sales to help you safely raise more capital with less effort. So that's
Another thing, yeah, and another thing to mention as well that I want to say too is someone also asked, hey, if I work with you guys, do I have to use TribeVest? So real quick, I just did a show, Travis, for Fun Friday, episode 1. So hopefully everyone can listen to that. If you're curious to learn more about, TribeVest, Travis, that story, and why it's important in syndications, please refer to that episode. And if you have any questions that you think we should ask on the Fun to Fun webinar, please let me know. Please let Rob know. Questions, please drop it in our mailbox. That said, you don't have to necessarily use TribeVest. You can use the various other competitors out there if you desire. We just want to make sure that you guys know this is an option there. TribeVest just seems economically, very viable, and some of our partners have been very, very open to that. But feel free to use any fund setup you want to use. If you have done this yourself and have been raising in this manner for the last couple of years, then continue using your people. One person, actually, Randy Smith, believe it or not, said, hey, I've been raising in the fund structure. Do I need to use TribeVest exclusively, or what does that look like? And I said, hey, you can use whoever you want to use, when you want to use them. It's not a problem. So I just want to debunk that. Do you have any more comments on that topic, Rob?
No, that's a good point. Absolutely. And similarly, when we sent this document out to some of our partners, they saw this $1 million minimum at the top and they got worried because they maybe at this point in time don't feel comfortable targeting that amount. And so we simply said, hey, not a problem. We want to work with you. We enjoy working with you. 500,000 is okay. So yeah, don't be scared off by that minimum.
Yeah. And what are the economics if you're in that $500,000 range, would you say?
Right. So people are anticipating there to be different structures and classes for the different amounts. If you come in with a $500,000 fund to fund, we will, depends on who you are. Of course, it says exceptions made at LSC's discretion, but we're not going to just all of a sudden crush your economics and give you a worse deal, right? If you're a good partner of ours that we've worked with in the past and you come in with 500K, you get the same deal structure. What will be different though is the fixed costs associated with the fund formation are obviously going to be more expensive relative to a smaller raise. So if you raise 500K, the fixed costs are going to be more meaningful than if you raise 5 million, right? The fund will barely feel the fixed costs associated with creating a PPM and the entities and everything like that. So yeah, I don't want to go through every point here. We'll save that for the
No, it's
webinar,
okay.
but I think those
Yeah.
are some of the highlights. And if you see anything else, I mean, one thing I'll point out at the bottom here is example deal economics. The spirit of the fund to fund structure is that the LPs of the fund to fund are getting roughly the same returns as if they were to invest directly. And so, for example, if we have a good partner of ours that has their investors that invest with them into our deals, we don't want to disincentivize that chain of relationship to not exist, right? We want our fund to fund partners to be successful. We want them to have happy investors. We don't want their investors going, well, why don't I invest directly with Lone Star and save money, right? Because if you just look at the example economics down here, and I know for people just listening, you can't see anything, but you essentially see that the returns are the same whether you're investing directly into the deal or through the fund to fund. So I think that's really important for people to know, whether you're an LP or a fund manager. Let me just turn my light back on. So yeah, I think that's pretty much it. Do you have anything else to add?
I will add this. If you want to look at this because you didn't get the document right away, please reach out to me, Craig at lscre.com. If you think there's anything that we can do better and to improve on our process with anything with Lone Star, we're not pretending that we have all the answers, and we're open to solid constructive criticism and feedback, particularly the fund process and just to get better here. So let us know if there's something we can do that you think would be a useful idea. As I said, email me at craig@lscre.com. And if you're looking to raise equity for our deals, craig@lscre.com. Sorry, Kent. They're the shameless plugs for the episode. Moving on to conferences and thought leadership. So you just got back from Miami and Chicago, and you met with a lot of high profile people in our space, big equity people, big check writers. So maybe talk about the conferences and also how maybe important thought leadership is. And now that you're more on TikTok, or I guess you'd say Weston, our exclusive partners, Weston and Chris, just got our content really dialed in. I think we're really going to ramp that up even more. But talk about maybe conferences, our approach there, what you saw there, how high level people saw, the big check writers are even seeing your content, our content, and just thought leadership as a whole, because this is a really big thing. I think we do it in a very, I'm not gonna say unique way, but for those who are not in the business, they would consider it unique. I spoke with several people about this, saying how much they see our stuff, how much they like it. So it's interesting. So maybe walk us through the conference plus thought leadership and tie it all together.
Yeah. So, I mean, you mentioned TikTok. Unfortunately, I don't think we're getting any big checks from TikTok, but who knows? Maybe an influencer, maybe like a 19-year-old influencer is making millions and they give us a nice $1 million check off TikTok. Who knows? But LinkedIn absolutely has been a fantastic ecosystem and community for us to put our name out there and put out good content and get more exposure. So one of the big early myths that I used to believe, and I think a lot of people still believe today, is that, well, all this marketing stuff is nice, but that only works on unsophisticated people. Savvy investors, it doesn't work on them, or something to that effect, right? People don't think that thought leadership is effective. Well, I was just at Ascent, which is it's one of my favorite conferences. It's put on by Biz
That
Now,
you'll that
and
you'll never go to again, that
well,
you're
we'll see.
retiring from.
Yeah, perhaps. Well,
Right.
I'm just not a big fan of conferences, and you do so much better than I do in person. I'm antisocial. So with that conference, there's a lot of institutional equity. Just it's very high level. It's really great show. And I was so delighted and pleasantly surprised when I had multiple people come up to me, or not even come up to me, but the meetings that I reached out. So I'm scanning the attendee list, and we can get into how we approach conferences, I think, in a bit. But prior to going to the conference, I actually downloaded the list of attendees and I researched every single person. And I found the people that I wanted to meet, and I reached out to them and scheduled a meeting ahead of time. And it was very nice and what an advantage it was to sit down with somebody that I was trying to get a meeting with. And then they say, oh, by the way, I love your content that you post on LinkedIn, or, I'm getting great news and updates from you online. It's great to see this
Or
XYZ.
so and so has heard of you, or so and so recommends you. It really breaks down a lot of barriers and doors.
Right. All of a sudden
And
that conversation is so
yeah.
much easier. And I mean, we have to sell ourselves and we have to put our best foot forward, but I'm not trying to prove myself, or they don't need to get to know me as much because they feel like they already know me because of the content that we put out. So I'm not going to say that our strategy is perfect or that our content is perfect, but this strategy is so effective, and it does work for these institutional groups because they're on social media as well. And if you can speak to them and have them as the dream investor that we want to speak to, then it's going to be effective. So that was really great, and I had a great experience at Ascent, and I'm sure you'll have a great experience there next year as well.
Well, I had a great experience at Elevate where I got several, JV potential partners there, which is exciting. So Elevate is definitely high level. But, just talking about thought leadership too, on your end, did you feel like you had maybe imposter syndrome or feel uncomfortable kind of broadcasting yourself like that, especially such a young age? Because I still am becoming more comfortable with it, but I'm a pretty outgoing person. But even sometimes I feel myself cringing when I see my content, whatever it may be. How long did you have that feeling for? What advice would you have to people who maybe are younger in the business or even older that don't know really where to start? How would you go about it in their situation, and maybe walk us through some of your insecurities when you were doing it to start?
Yeah, there's plenty of insecurities, and I think it's a double whammy when you're young. But similarly, older people who have more experience, they still ask me for advice and say, well, should I create content? What kind of content should I do? They're hesitant, even though they have some experience and whatnot. So when you're young, it's a double imposter syndrome. And so yeah, I definitely experienced that, but I had to swallow that and not I had no other choice because I saw what was going on in the business, and I recognized that our success depended on us building a brand, because like we talk about this all the time. We're not in the business of dollars and cents and percentages. It's more than that. It's people, it's relationships. People want to work with people that they know, like, and trust, and there's a lot of work that goes into building that know, like, and trust, and it has nothing to do with spreadsheets, nothing to do with IRRs. Those things are great. That's what I'm actually passionate about. But I recognized from early on that this is do or die. We have to build a brand. And so, yeah, I felt imposter syndrome. And I think, I haven't really checked in with myself, kind of feel where I'm at today, but I kind of think that you should always be feeling imposter syndrome, because if you're not, you're too comfortable and you're not pushing yourself. It's kind of like dress for the job you want, not the job you have. Right. So maybe wearing that suit, if you're not already, makes you feel uncomfortable, but that's the point. Dress for the job you want, not the job you have, right? Make the content for the firm that you want to be, not the firm that you are, and all that. So we need to be pushing ourselves and making ourselves feel uncomfortable.
Yeah, and on your end, what's your vision for content? What's your vision for, elevating what we're doing currently? Because I think we've got some really exciting stuff, like the founders video, like the episodes we're doing. But, what do you think on your end at this point would get you out of your comfort zone? What on your end do you think would make you, push and could really elevate what we're currently doing?
So the biggest thing that I see is, because, to be honest with you, I did get quite comfortable in my content flow. We were cranking out the same content. I was doing webinars. I was recording on my phone, simple selfie videos, making little notes.
Raw.
People like those videos, and those videos are cool. And I got comfortable. And the latest thing that we're doing now, which is uncomfortable, is we've leveled up the production value. We've hired Weston and Co. and we've got, which is an awesome video team. If you need a video team recommendation, I don't even want to give it to you because
I don't.
don't want
Yeah, it's
I don't want
I'm
them to get
selfish here.
busy.
I don't want them to not be able to go, to XYZ spot and to have, situations where we're overbooked. And I think they're at the point where they're skilling up where that's not going to be the case. Is
These
they're
guys are so
becoming,
busy. They're going to
yeah,
Hawaii, they're going to Saudi Arabia. But anyway, if you
no, they're hanging out in Saudi Arabia
but
or
in
Arabia. Yeah.
all seriousness though, if you do have a nice budget and you want the best video team, please reach out to us. We'd love to connect you, even though we don't really, because we want them all to ourselves. But anyway, hiring them and doing these videos where Weston is breaking it down and asking me personal questions. And I always shied away from speaking about personal topics on camera because of imposter syndrome. I didn't want to talk about myself because I was a 21-year-old dropout who had no experience and nothing to offer. So why would I talk about myself? I'll talk about anything but myself. Let's talk about the spreadsheets and not me, right? But now he's pulling it out of me. He's getting the personal out, which is actually, funny enough, what people want to hear, right? Yeah, you need to have your cap rate and all this, all that has to be dialed in. And trust me, it is. We can get into the numbers anytime, but people want the people element. So that was a bit revolutionary and pushed me out of my comfort zone. You saw when we did some recordings, which I can't wait to see them here at night. We came at like Saturday night, 11 p.m. It was such a busy night and day. And we turned all the lights off in the office and we're shooting this cool skyline view at night and doing these nighttime videos. And I'm staring down I'm like looking the camera in the eye, and it's personal. And this is hard. This is uncomfortable. All right. And that definitely pushed me out of my comfort zone, because it's different than just, I don't know, doing a Zoom call or, recording a video with a selfie, right? It's
As the
it's
TikTokers
different.
say, that was giving Last Dance. It was
Right.
truly, truly really cool to be a part of that, watch it, witness it. And yeah, no, it's really fun to see the other side of you, because I know probably better than anyone what your full personality looks like, and there's a ton of it, and what your business world looks like, obviously, because I'm in lockstep with you in regarding to that. And you have a lot more to offer, and a lot more, you're a very silly and funny person, and you're Mr. Suit and Serious in the business setting. I don't think that's going to change ever, or at least anytime soon. But there's a lot more than just that side to you. Naturally, with anyone, we're all people. We all have lives, and you have a full and rich one in many respects. So it'll be cool to really showcase that to the world. And for anyone, you want to be yourself and be authentic. There's only one of you, so find your voice, find your path. I'm working that as we speak right now. I feel uncomfortable doing it, but I know that in a couple of years it'll pay off. But my positive feedback loop from this has been, oh my gosh, people are actually starting to reach out to us and email me every single week now, several people. And it can be you if you want to email me right now, craig@lscre.com, if you're a fund manager. But people are literally now emailing us in regards to wanting to work with us. And we're getting new capital people in there from literally talking about real estate online and being the voice of reason. And I think, as Hunter Thompson has said, either be the loud voice, or someone that's way less talented, or someone that's worse deals, or whatever it may be, will be the loud voice, and they will get that money. So you're only taking equity out of your pocket. You're only taking the opportunity out of your pocket. And putting yourself out there and broadcasting, it's so efficient. It's not one-to-one like a phone call is. It's one to many. So create that echo chamber for yourself. Be a voice, be a thought leader in the space.
Good stuff.
Okay. Any other thoughts about conferences? The best ones that you recommend? And then, do you want to give people a little snippet into how we run our conferences? Because we always get comments and compliments as well regarding our structure. Or do we not even want to give that away because it's too good? It's too powerful and potent.
I know we're always giving our secrets away, but people appreciate that, so we might as well. So yeah, I don't really have anything more to add, but let's talk about our general conference strategy, because we were in New Orleans and we're going to be in Phoenix, and we're going to be doing our thing. We're going to be in Salt Lake. So why don't you share kind of the strategy and how we make the most of our time, because we take our time very seriously. Going to a conference is a major investment of time and money. So I have anxiety about getting the value.
So my thought is this: conferences, as I am the lone star remote, quasi remote, because I'm in about 3 or 4 months of the year in New York. So mostly remote employee. We got lights flickering in the background on your end. Mostly remote employee. But conference is really where we make our impression, and where I feel like I am really most valuable to the firm, to the company. So, and if we're going to go, it's a big investment. We have hotel rooms, we have tickets. I mean, the average conference, if we're both going, it's probably running us $5,000 minimum, but it could be 10 grand, all together. So it's expensive. So we need to raise some money. And logically speaking, that's about, if it's going to cost us 10 grand to be there, we got to raise probably at least $500,000 from that room to make it economically viable. But what we'd like to do, as you mentioned, we scout the whole list and then we stack meeting after meeting after meeting. So many people go to conferences and maybe they need content. Maybe they need that lightning in a bottle motivation, that juice and that jolt. I'm sorry, I don't need any of that. I'm a very naturally motivated person. We both have very big goals and aspirations. And what we need to solve for is people and equity. And we meet with equity during the entirety of it. We try to stack meeting after meeting after meeting, and then strategically plan dinners, people after, lunches, breakfasts, whatever it may be, cigars, drinks. But we really attack it, and we make sure that we at least meet with 20 people. So if we're and these are conferences that we're probably like the Raise Masters ones for hunters groups, or if we're at BEC, we try to at least meet with, I would say, 15 people that are equity providers and whatnot. And the way I look at it is I'm very competitive. I know our competitors are going to be there, and I'm just not going to let any of our competitors be there with at least me not being in the room as well to get a little inch of momentum with that individual too. So I feel as if with conferences sometimes we can't afford to be there, but just because the competition perspective. But in summation, we basically stack up 30-minute meetings during the entirety. We leave an hour for lunch, and we're really at it from 9 a.m. to 5 p.m. that day. And we're meeting with a ton of people and multiple days stacked up. It's very productive, but conferences where we get a lot of money. I think from Raise Fest in Louisville last year, I would imagine we raised maybe $15 million from that event, just from equity into deals right after. So
Right. And
if
it's not that event, it's also a rep. It's attrition. And we, you need to meet someone multiple times. You need to build the relationship. You need to follow up. And so this is a slow business. It's a slow game, right? This is not a get rich quick. And so that's perfectly fine. We put in the reps, we show our face. Hey, we're here. We're still here. We're ready when you are. And we're building these relationships. And then to your point, you mentioned lunch. There's typically conferences have breakfast, they have lunch, and then maybe dinner might be free, but you want to, here's a little secret, but everyone, I don't like that. This lighting's horrible. I need to fix this.
your lighting's been very, very, very funky and wonky for the last
no, this is unacceptable.
30, 40 minutes.
No. Now that it's winter and it gets dark this early, I need to get lighting in the office. This is unacceptable.
2 words, if you're a real influencer like me: ring light.
Correct.
And this is also why we need the podcast studio to be up and cracking, because if we had that, we could solve for this. But it's a slow process.
The podcast studio is in progress. So what the not really a secret, but the tip that I want to share is the breakfast, the lunches, the dinners. That's for the VIPs. You really want, if you're going to spend an hour with somebody over lunch, you want to make sure that that's intentional. You don't want to just go grab a plate and sit down at a random table and sit with whoever happens to be sitting there, right? You want to be intentional and schedule those meetings and really spend time with who you want to be spending time with. So it's all about
this is not nothing about a conference for at least how I perceive it is by chance. Like maybe I come off a little too thirsty and aggressive. I don't care. It's just how I roll at something like this. If I'm being there, if I don't call Rob after a conference that I went to that the company spent money on without some sort of lead, I feel like an idiot and I feel like a loser. And also it's like, well, what were you doing for the last 48 hours? Like it would be a waste of time. Frankly, there's a conference here in Arizona that I was slated to go to, but I actually opted out because there just was not enough people to meet with for me to justify, being there for 2 days and letting my email stack up and not really moving the company needle. And if I was there just hanging out, shooting the breeze, drinking some coffee, meeting some people that I don't think I'm going to transact with, that is just not a good use of time, period. If you go to a conference and without an agenda, you're just going willy-nilly, I think you kind of just burnt money. Like that's frankly my opinion. You better be there meeting people.
Conferences are high risk, high reward. Let's leave it at that.
Yeah. Next subject is lack of buyers in the market, but it only taking 2 to make a deal. So I think some markets are different. That's the most obvious statement ever being said. For instance, Dallas is still having a best and final process for a lot of deals. Now we're starting to see, whisper prices or, pre-market offers with, maturities coming up. Maybe the prices are a little unrealistic, but at least that's out there and that's kind of changing a bit. It seems as if Houston, though, in San Antonio is having offers as they come, which means there's not multiple offers in place. So what do you want to comment on in reference to, lack of buyers in the market, if you will, or maybe not lack of buyers in the market. Can you talk us through your thought process here? Because this is something that you were very excited to speak on.
So we definitely know, everybody knows there's less buyers today than before. There's less competition, prices are coming down because of it. And so what we're seeing is it's getting thinner and thinner. And I think it's only going to continue that in that direction. I think people are going to fall by the wayside and there's just going to be fewer buyers. And so what we're seeing is, and in Houston in particular, which is a market that we're very plugged in, there's maybe, this is broker intel that we're getting, there's maybe 5 groups that are good, legitimate buyers that are active in the B and C multifamily space in Houston right now. That's 5, not 55. So that's not very many people at all. That's very different than 2 years ago when you were having a best and final and they'd invite 5 people to best and final out of the 25 bids. So it's a different world. With that being said, though, the interesting thing that you have to recognize, or that I'm learning, is that it only takes 2 to tango. And so if we are in a bidding situation on a property, if all the buyers are gone, but there's us and one other group, we'll still bid against each other and find that market clearing price. We'll find equilibrium, right? All it takes is one other bidder to push us to our top number. So it's not like we're able to steal deals. So I think it's a healthy reminder that you can't get too greedy. Even though we're very confident that deals are extremely attractive and they're only going to get more attractive as we head towards the bottom of the cycle, you can't get greedy. If the numbers look good, pull the trigger. Don't try to wait and see if you can get it for cheaper or hold back your bid because you don't think anyone else is there on the other side. We just got outbid on a deal last week because the other buyer on the other side was all cash. So you never know what's going to happen. You always need to put your best foot forward to win a deal. At the end of the day, this is a very competitive business. And that's a healthy reminder because I'm a deal junkie and I'm a deal maker. And when I see an opportunity, I'm trying to squeeze it and get the best price possible, get the best deal possible. And that has to be balanced with, hey, don't get ahead of yourself. Don't get too greedy. If the numbers make sense, be happy with a good deal. So it's just an interesting concept that all it really does take is one other bidder competing against you, and it's going to push the price to that market clearing price, and let alone 5. So as we're seeing less competition, it's not like we're the only one at the bid.
Right. And if there's only 2 buyers, though, what's that like? Is that, usually a back and forth? Is it kind of the best and final? Because a buyer like us might say, you know what? No, like you're leveraging our offer too much, or, take the other offer, right? So they could really be in a situation where or they shoot themselves in the foot if you're a broker by maybe trying to go too aggressive with counters and whatnot. Some buyers get emotional, just say, no, I'm walking away. So, how much back and forth is there typically if there's only 2 buyers there? And how do we kind of combat and mitigate that? And also, how does it work when you feel like you're negotiating against yourself, right? So can you walk through all those things? Because ultimately your basis is, a lot of times where you make the money. And that's the one thing in real estate you can change is the location and the basis, right? Or the 2 things. So, can you kind of expand on that?
Yeah. So I think whether you are negotiating against yourself or one other buyer or 20, you have to stick to your guns. You can't get caught up in the bidding process. And so you need to know what your numbers are and you need to know where you're drawing a line in the sand. And that makes things a lot simpler. You don't have to overanalyze the situation. You just have to know, okay, I'm willing to pay X, I'm willing to do these terms, and that's that. And then of course you try to do better than that, but you have to draw your line because if they try to counter, you have to be prepared to say no and be prepared to walk away. So what we're seeing right now is an interesting mix of offer scenarios. So some sellers are selling right now because they have to and they need the deal to go through. And so they're prioritizing certainty of closing over anything else. And I don't just mean certainty of closing because it'd be nice to not have a deal fall out of contract. I mean certainty of closing because I need this deal to close. And if I don't, I'm going to have major problems with my lender. And that's different than 2 years ago when people also wanted certainty of close because pricing was so good, right? Bids come in, everyone's bidding a high price. So all the prices look good. So now it comes down to hard money. How fast can you close? How certain you are, what your reputation is, right? And people were happy with, okay, put up a big hard money deposit. And if you don't close, I'll take the deposit and I'll move on and I'll put the deal under contract with the new guy and sell for a higher price. Still, that's not today. Today, you can offer hard money, but that is not valuable to a seller if they still don't believe you're going to close, right? If you're willing to offer 200K hard, but the seller's still iffy about your performing on the deal, they're going to pick the other group that has nothing hard, but they're certain of them going to that they're going to close. So you're seeing a lot of those processes right now, and they're motivated by certainty of closing and speed of execution. And so because we're talking about speed, they often don't want to go through a full best and final and counter back and everything. Like, they just want to pick a group now. And you're seeing that, which means that you might not get another bite at the apple. Whatever bid you submit, they might just pick out of the bunch and move on with their lives. So that's also, just that's why it pays to have good relationships with the brokers, so that a broker can effectively guide you throughout the process. If the broker says, hey, I think the way that this is going to play out is people are going to put their bids in and then the seller's just going to pick, you need to put your good bid in. Don't hold back. Other times, you know that you're going to put an initial bid in and then you're going to get invited to best and final, and then you're going to have to counter yourself again. And that's when you hold back on price, right? So it's when you know when to put it all out there, when to hold back as a negotiation tactic. It really comes down to your relationships with the brokers.
So with that said, if, on our end, would you say it's pretty safe to say there's some brokers we like working with more than others because we feel like we have good relationships, or they'll steer us right? Do you feel like there's some brokers you've spoken with in the past that, they're just blowing smoke and you can't trust them? Or, hey, frankly, this broker has no loyalty because, and maybe we'll go through this well, most deals in the space we're in, they're double-ended, right? Meaning the listing agent is also the buyer's agent, right? So let's say, shout out to our boy Stockley. If he works with us in a Dallas deal, is he, the listing agent communicating with 3 other sponsors just like us, trying to get them all up? Is he, blowing smoke to us because he wants a different sponsor to represent it? Does he just basically get to gatekeep the process with who buys what and kind of control the inventory? Can you, theoretically incentivize people, wink, wink, to help you get the deal? Walk us through that, because there's so much more to this business, as you mentioned, than just dollars and cents. It's the human aspect, right? So how do you navigate that part? And how do you, kind of vet brokers and make sure that they're telling the truth to you and that they're giving you good information?
It's tough. It's tough to say. And, you never really do know. But like you said, it comes down to relationships. And you're right. The vast majority of these deals there's only one broker involved, and they're being hired by the seller to conduct the transaction, and you're communicating with that broker, and they're also communicating with all the other buyers. And so you need to win them over. And what do brokers care about first and foremost? Their commission. They want to get paid.
So certainty of close, effectively.
Certainty of close with the least amount of headache. And so if you're a headache buyer because you negotiate every point on the PSA, because you drop deals, because
you're not agreeable.
Right, you're just a pain. You're just a curmudgeon.
A chronic retrader, or having to move things around, erratic, not pleasant.
So they're not gonna. That's gonna catch on, and that reputation is going to catch on. So we work hard to just be honest, good guys that do what we say we're going to do, and that works well. People want to work with us, and we're not going to say that, yeah, we're the best buyer and you should pick us every time. Of course, we need to earn that, but that's what our goal is.
Absolutely. Yeah, I mean, it's a lot to navigate, especially if you're a new sponsor. Starting from ground zero, it's not easy, but it's a good time to do it right now because most deals you pick will be winners. Moving on to loan assumptions. So loan assumptions has been something that has been a really sticky topic and something that a lot of people like to do, but there's also some downside of loan assumptions. And what I mean by that is you don't want to buy or, get in bed with a deal with a bad basis due to, yesterday's debt and yesterday's pricing with maturity coming up. So, how do you kind of balance loan assumptions? And then also let's talk about DSCR versus LTV, right? So let's kind of have a deep dive into that. And let's hear your perspective on this. And maybe what was loan assumptions and these kind of creative solutions to get deals done. Is that something that was discussed recently that you experienced? Can you talk about that for us?
So we've talked about loan assumptions before, and we've talked about you made the very poignant comment that you might be able to buy a deal today with positive leverage because you're assuming the below market interest rate loan. However, you might be overpaying for that deal. So you might be getting good cash flow, but you overpaid for the deal so that when it comes time to sell, you're actually going to underperform from an IRR perspective. And so this brings up the general idea or concept that when you do a loan assumption on a below market interest rate loan, so let's paint the picture. Today, let's say interest rates are, let's say 6.5% today. And let's say you can buy a deal and assume its existing financing at a 4.5% rate. You're getting a below market interest rate, which is going to be better for your cash flows. But if that means the bidding process bids the price up of the deal down to a 5.5 cap, whereas if the deal sold free and clear, it would have traded for a 6.5 cap, right? You overpaid by a 1% cap. You overpaid by a lot, frankly. I'm just painting random numbers, right? I didn't actually break this down before. Hypothetically, right? So you're going to get decent cash flow. You've got 100 bips of positive leverage, right? You bought it at 5.5, you're financing at 4.5, got 100 bips of positive leverage, but you overpaid for the deal. So if your exit cap is, let's say 6.5, that's not as good. That's not looking so good, right? So in these scenarios, when you're assuming a below market rate, what you're doing is you're trading away total return in exchange for better cash flow. You're basically saying, I'm willing to pay more, which means I'm going to get a lower total return down the line. But in the meantime, I'm going to get better cash flow. So it's the balance of, do I want to prioritize IRR or do I want to prioritize cash flow? And that's the answer or the question that people have to answer when they're talking about loan assumptions today. However, what's really interesting is back in, let's say, 2019, 2020, the reverse relationship was true. Let's say 2020, when rates came down a ton, market interest rates were 3%. But if someone originated a loan in 2016, 2017, 2018, the rate might have been 5. So now what that means is that seller who's forcing you to assume that above market interest rate loan is going to sell at a discount, not a premium, a discount, because you're assuming they're bad debt. So what that means is in the interim, because you're assuming the high interest rate debt, you're going to get worse cash flows in your hold period. But because you got spotted at a discount, you're going to get a higher IRR in the end, or at least you should demand it in your bid, right? So in that case, you're trading away cash flow for higher IRR. So it's this relationship in the capital structure, whether you're assuming an above market rate loan or below market rate loan. Are you trading away worse yield for better IRR for worse yield? So that's just an interesting dynamic that we're seeing in the market. And so we're cognizant of that. And we don't get super excited if we see a low interest rate loan assumption deal. And we go, because a lot of people go, look, I've got a great deal. The interest rate is 3.5%. It's like, well,
yeah, it's a sucker play. It's novice if you think, oh, that's the only, factor.
Exactly. You have to dot your I's and cross your T's and make sure that the basis is still good and all the other finer points of the deal make sense. So with that being said, we are looking at a couple loan assumption deals right now, as a matter of fact, which look quite interesting because if you can get in at a discount because of just the market dislocation today and you get the below market rate loan, you can get some really good yield and total return. So I'm excited about that. I think it's possible, but you just have to be aware of these general mathematical dynamics.
Awesome.
So
which leads us into DSCR and LTV. So interesting pushback recently. As I said, we may or may not have a deal that we're looking at, and it may or may not have incredible positive leverage, which is a cap rate being higher than the debt note. So it allows us to utilize more leverage. However, right now people are trying to avoid leverage because of the debt market. But even so, with interest rate and the debt there, our LTVs really high. So can we talk about DSCR, which is debt service coverage ratio, which is needs to be above 1.25 for the deal to make sense from a agency play, right? So let's talk about DSCR versus LTV and how that all plays maybe together with loan assumptions, and then also, how DSCR and LTV are correlated.
Yeah. So just to take things to start from the very beginning, LTV, loan to value, and DSCR, debt service coverage ratio, are lender risk metrics. So when a lender is underwriting a deal and they want to put a loan on a property, they look at those two metrics. There's other metrics as well, but they look at those two metrics to size the loan. And so generally speaking, what they do is they're looking to size to the lesser of one of those two metrics. So for example, if a property is $10 million, they might only be willing to loan $7.5 million because that represents 75% LTV. And that is what their risk tolerance is. On the DSCR measures how much income there is relative to the debt service. So let me just point out a few things. LTV says nothing about the interest rate. The interest rate could be 3%, it could be 6%. LTV is still going to be, let's just say, if it's a $7.5 million loan, the LTV is still 75%. With DSCR, it takes into account the interest rate, because the higher the interest rate, the higher the debt payment is relative to the income. So if you have, let's use this example of $1,250,000 of income, and you have a $1 million debt payment, that's a 1.25 DSCR, meaning the income is 125% of the debt service. So you've got a 25% cushion there of cash flow. And that's really important because that's a risk metric. So what can happen though is you could have, let's say interest rates are really high. You could have that DSCR at 1.25 minimum mean that the loan can only be 50% LTV, not 75. So it's an interesting relationship. And what we're seeing is, like you said, we have a new deal that by this time this airs, it'll be under contract. The deal is very attractive from an in-place income perspective. There's so much in-place income, right? That $1 million of NOI is, let's say, 1.5 or 2. So actually, from a DSCR perspective, we're not maxed out. We've got plenty of income relative to the debt payment. The problem is we can't put any more debt on the property because we're bumping up against the lender's 75 or 80% loan to value constraint. So I want to say that I think both are very valuable, right? It's helpful to know that the loan is 75% leverage, because then you've got 25% equity cushion there between the property value and the loan basis, right? And that's your cushion. That's downside protection. Similarly, a 1.25 DSCR ratio, you have 25% cushion on your income. If your income goes down by 25%, you can still cover your debt service. That's really important. So both are good risk metrics, but what I would argue is
and real quick, and the importance of that too is because when people sell real estate and the cap rate, that's just a function of, the yield of the property, right? Because they trade off yield. So making sure that that's there is just for your safety, and that doesn't mean you're completely safe, but it is just a barometer for, value of the deal. It's just very important. So things like this really need to be thought about as the market is shifting, and you should always be thinking about these things if you're on our side, if you're an investor. But notes like this to get smart, to make the good investment the right time versus losing your equity, and frankly, working with smart investors is important, because you don't want your deals ending up on the watch list.
So what I want to say is, if you only could pick one, which would you pick?
So are you saying, repeat that? So give a little more context.
You can only pick one, LTV or DSCR. Which one are you picking? If you can only know one about the deal, which one are you picking?
DSCR.
DSCR all day.
It's not even a question.
It's not even close.
It's recession proof, because frankly, okay, well, what if, DSCR all day, because okay, well, LTV is misleading almost, because if you're buying a deal in New York or the Bay Area or Los Angeles, LTV is going to be, probably really high or low, depending on how you want to say it. And the only thing that I need to know is how the debt looks in relation to income. So, and it will always vary, but DSCR is the canary in the coal mine in a lot of cases, and should make anyone feel good because these are debt-based decisions that you're making with commercial real estate. And also, these aren't 30-year debt terms. These aren't mortgages. These are sub 10-year loans, often really sub 5 years even. So. And DSCR really got screwed up when interest rates shot up and have been so volatile. So
right. So
that really outkicked the coverage there on that one.
Right. So if you have, let's say, let's paint that picture. So back when rates were 3%, your DSCR looked attractive because let's say your $1 million debt service was based on a 3% rate. Well, if your bridge loan went from 3% to 9%, your interest rate tripled. And now you're talking about, instead of a $1 million debt service, you're talking about $3 million debt service. That's a lot. Your DSCR went negative. So now actually every single month you have negative cash flow. So if you had, let's say, 1.25 million of income, and then your debt service goes up to 3 million, you're negative cash flowing over 1.5 million per year, right? And so that is a very precarious position to be in. And that's why DSCR is so important, because if you become over levered by virtue of valuation changing, that doesn't necessarily speak to your cash flow position. Because as we know, one of the beauties of commercial real estate is if you have income that's reliable and you're able to cash flow and pay your debt service, there's nothing forcing you to sell at that given moment.
It almost doesn't matter temporarily, unless you need
temporarily.
To exit. It just doesn't matter. I'm not saying it's irrelevant, because it's all, of course, very important, but you still have a moat around you should you have some more years left on your debt note. And if you don't have to sell in a less than fortunate environment, then you can hold it and you can enjoy the cash flow and the proceeds, and your investors are happy. It's when that floats up and changes and in your math and calculations are off is when it's a problem.
Right. So when your LTV is off, you can survive. When your DSCR is off, it's only so long that you can survive, because how long?
You can't outrun it.
How long are you willing and able to service negative cash flow?
And that goes back to when we spoke about this so much, and this will kind of tie into our next conversation, but if you're going to do a capital call, and this was said so much at our conference, so much just generally on these conversations like this, but it's one thing to meet a capital call that doesn't solve for long term, it's just making up some payments. That is burnt money. If you're not doing a capital call to solve for fixed rate debt, to solve for restructuring the capital stack, to basically allow long-term viability, if you're just doing that to make a couple of rent payments, you might as well just throw your money on double green on roulette and let it ride, because you could just be throwing away money. Sure, it might save it, but that's not likely, right? So it just goes back to that, having good fundamentals, making sure that your debt is more secured. There will be a conversation coming up for floating rate debt. That might be something we would consider on, or even bridge debt coming up if you're a buyer and a believer in the fact that debt's going to start floating down, which fortunately treasuries have been in our favor. So thank you, Jerome, for maybe handling and easing and tightening that, and maybe solving for a softer landing. But it's concerning out there. And with that said, what would allow one to end up on the watch lists? So that is, and also, what is that? So can you kind of unpack that? Because there's just an article that came out from The Real Deal, kind of just spotlighting, capital spotlighting. It was spotlighting some, deals that are of concern. And, what does that mean? Can you really just unpack everything at a high level like you, of course, always do?
Absolutely. So The Real Deal obviously sleuths around and is looking for drama to report on, which, not saying anything bad about The Real Deal. I enjoy their stuff for sure.
And we don't know one way or another, but this is just news, and we're not going to not talk about news. So
right, yeah, and they just are looking for things to talk about, and so it's interesting. So they've been pointing out sponsors of multifamily sponsors in our space that have essentially DSCR issues, that exact issue that we just talked about. And the way that they know about these issues is because a lot of these bridge loans that were made at the time when rates were 3, and now those bridge loan rates are 9, they floated up on these borrowers. These bridge loans were executed in a CLO, a collateralized loan obligation. And so the bond information. The information on these bonds is public. So the underlying assets rather. So it's public data. You can go on Morningstar, you can go on TREP, and you can see the servicer commentary. And a servicer is someone who's actually responsible for every single month managing a loan, right? A loan doesn't manage itself. You still need to collect the loan payment every month and the escrows and handle everything. So these there's servicer commentary, and the servicer is talking about, okay, the borrower is ahead on the renovations, the borrower is behind on renovations, the borrower didn't pay me this month, and there's some challenges. Or based on our analysis, we look at the financials and we see that the income is down and the DSCR is 0.7, let's say, or 0.8, which means that for every 80 cents of income that the property makes, there's $1 of debt payment. So there's actually a 20-cent shortfall. Extrapolate that out on hundreds of millions of dollars of loans across the industry. We have millions and millions of dollars of negative cash flow that has to be addressed and paid for every single month. So that either comes by way of a capital call or by the sponsors advancing funds, or by renegotiating with the lender and saying, hey, lender, I can't afford to pay that full debt payment. How about I pay you half now and we accrue the rest later? You know, you might get a middle finger, you might get some conversation there, but those conversations are already happening and people are already getting those sorts of workouts, which is very critical for a lot of these folks. So specifically, what happens is when the servicer of the loan becomes concerned about the well-being of the performance of the property and the viability of the loan to be paid, they will put it on a watch list. And so we're seeing a lot of deals. I mean, pretty much if anyone has a bridge loan that was originated within the last few years, it's going to be on a watch list. I mean, the numbers don't make sense. If you go from a 3% rate to 9% rate, the numbers don't add up. So these deals are going on watch lists. And what happens is if the performance gets any worse, actually the loan will get transferred to a special servicer. So it goes from the servicer to a special servicer. And a special servicer's only job is to handle loans that are in trouble. So once it gets transferred to a special servicer, it's ugly. And you need to start a conversation right away with the special servicer on how you're going to work out and resolve this deal. And sometimes they're friendly, sometimes they're not. Ideally, you can work it out before it even gets to the servicer. But the real challenge with these collateralized loan obligations, with these CLO type executions, is a lot of times the lender and the servicer have their hands tied in more ways than one, because the loans were packaged together, sliced up, and sold off as bonds. They have very rigid documents and very rigid rules as to what they can do. They can't willy-nilly allow the interest rate to be cut in half, or to change the duration of the loan, or give an extension, or waive fees. They're limited because of the rigidness of the CLO execution. So that has a downside there. But with that being said, and then let me also add the other reason why these lenders, even if they want to work with their borrowers, they have their hands tied a bit, is because they don't want to, just as the borrower doesn't want to admit that they have problems with their loan, the lender doesn't want to admit that they have problems with the loan either. Because if the lender acknowledges that, let's say, their loan is impaired because it's delinquent, or because the property is not worth what they are marking on their books, and they have to, if they acknowledge these issues, they have to re-rate that across their entire portfolio. And that's going to have major implications across their line of credit, across then the rating agencies get involved, and it's going to impair and impact their ability to issue new securitizations. Which, what does that mean? That means it makes it harder for them to do new deals. And how do we all make money in this business? Deals, deals, deals. So these lenders want to play the extend and pretend game with the borrower just as much as the borrower wants to play the game with them. So that's why I always say that distress doesn't happen overnight, right? It's going to take a long time for this situation to play out until they can't pretend anymore. And the borrower goes, listen, I can't pay these payments anymore. I give up. And they give the keys back to the bank. The bank goes, shoot, I don't want these keys. And they're either quick to sell off the paper at a discount, which they're already happening, or they foreclose on the asset and then they sell the property at a loss at potentially, in many cases, at a price that will be below the loan amount. So not just the equity that gets completely wiped out, the lender actually loses money because the lender's loan basis is, let's say, 10, and they're going to end up selling the property for 8, and they lose $2 million. So that is the word vomit of the day as far as watch lists, servicers, special servicers, and workouts.
So a lot of people in more of the retail, less sophisticated space are going to ask, "Oh, is last bitch watch list mean, oh, these property being foreclosed on, and I'm gonna go to the bank to buy them, or what's the path to foreclosure in these situations? Is it, this is just kind of a light bell ringing? Is this really concerning? If we had a deal on this, how would you feel?"
I mean, I know what's going on with our properties, so it wouldn't really change how I feel. I mean, the reality is the reality, whether the deal's on the watch list or not. The reality is what it is. So it's like I said, it takes time for this process to happen. If a lender wants to foreclose, they can, because pretty much everybody is in default today. In one, not everybody, but everybody that has a bridge loan is in default in one way. They're not meeting their DSCR covenant. They're behind on renovations. The lender's not making construction draws. So if a lender wants to, they can look through their 200-page loan document and find a way that you're in default and they can foreclose. But they're not going to do that because, like I just described, they don't want to foreclose. They don't, like Barry Sternlicht at lunch today talked about how they have they have a office tower in Milwaukee, and they tried to give the keys back to the lender, and the lender said, "No, we're not taking this thing. Why don't we give you an extension and you can keep paying a discounted interest rate or something?"
Because they can't offload it. There's no value there.
There's no value there. Yeah. I mean, a lender doesn't want to recognize that loss. They'd rather collect interest and just extend and pretend.
I'm hearing some places that where offices are, their highest and best use is literally to destruct them and to
100%. That's
basically add
absolutely
multifamily, which is one of the reasons why we don't want to buy multifamily in downtown areas, because units are always coming up. It's supply rich, not a supply moat situation. So any final thoughts that you have for today? This has been very jam-packed. We've been going almost for an hour and a half, I want to say. Can't say, I think you may be the recording, but any final thoughts on, watch list, loan assumptions, the state of Lone Star?
I'm actually really happy that we got through, I think, most of what we wanted to talk about in a timely manner. So I really appreciate everyone listening, and I hope they got value from it. And let's have a conversation. If you have something interesting to add, please put in the comments. If you agree, disagree, let us know. And if you have other topics that you'd like us to cover in future episodes, please let us know as well.
Yeah, so you can message at all and give me your complaints, comments, feedback, or criticism to me, Craig at lscre.com, Craig at lscre.com. We really appreciate you listening to the show. We're very excited for what's to come up. And also, if you have any industry tea, if you have any information, if you know of any deals that are actually good deals, don't send them to me, actually, because they're never going to work for us. So if you're someone that wants to send me a deal, don't. But with that said, thank you for listening. This has been a very fun episode, nutrient dense. We look forward to seeing you next week. Peace.